I'm going to tell you something about geopolitical risk that's going to make you uncomfortable. And it should make you uncomfortable because what passes for financial advice in Europe right now is catastrophically dangerous for anyone who actually wants to preserve their wealth. You've got every mainstream financial advisor, every talking head on CNBC Europe, every fund manager in London and Frankfurt telling you the same thing, which is to stay diversified in a mix of European equities, some U.S. stocks, maybe some bonds if you're conservative. Keep most of your cash in euros or pounds. And don't worry too much because the system is stable and governments have everything under control. And I'm sitting here watching this circus thinking the same thing I've thought for decades, which is that when the entire financial establishment is telling you everything is fine and you should just trust regimes who will use that leverage against Europe the moment it's convenient for them. You've got demographic collapse across the continent. That means your pension systems are mathematical impossibilities. And your governments know this, but they're going to keep pretending everything is fine until the day it isn't. You've got NATO expansion and proxy wars that have put Europe on the front lines of conflicts where the downside is nuclear escalation, the traditional approach. That's usually the exact moment your wealth is about to be destroyed by forces they either don't understand or have every incentive to lie to you about. Let me be absolutely clear about what's actually happening right now from a European investor's perspective, because the geopolitical risks you're facing aren't some abstract future possibility. They're concrete realities that are already destroying your purchasing power, and they're going to get worse. You've got the European Central Bank that has backed itself into a corner where it can't raise rates high enough to stop inflation without collapsing the entire European banking system and the sovereign debt markets of half a dozen countries that never should have been in the euro to begin with. You got energy dependence on Russia that was supposed to be solved, but has simply shifted to dependence on other authoritarian, kind of catastrophic devaluation. Couldn't happen here. And you're right that it won't happen the same way. It won't be hyperinflation tomorrow. It'll be a slow, grinding destruction of purchasing power but's been going on for years already and will continue for years more, punctuated by occasional crises that accelerate the process. Look at what's happened to the euro against real assets over the last 20 years. Look at what's happened to your ability to economic devastation. And the upside is what exactly? The privilege of paying for Ukraine's reconstruction while your own infrastructure crumbles. And here's what kills me about the conventional advice European investors are getting, which is that it completely ignores the single most important lesson from history, which is that when you're in a region that it's geopolitically vulnerable, when you're dependent on imports for energy and food and security, when your currency is a political construction rather than an economic one, when your governments are running deficits they can never repay and printing money to cover the gap, the absolute worst thing you can do is keep all your eggs in that basket and hope for the best. I've watched this pattern play out over and over again in Argentina, where people who kept their savings in pesos got wiped out, in Venezuela, where the educated middle class saw their lifetime of savings become worthless in a few years, in Russia in the 1990s, where ordinary people who trusted the ruble lost everything, in Zimbabwe, in Lebanon, in Turkey. The pattern never changes because human nature never changes, and the incentives facing governments never change. When politicians have a choice between defaulting on their promises or printing money to keep the game going a little longer, they always print. And when they print, the people who suffer are the ones who are responsible and saved in the currency those politicians control. Now, I know what you're thinking because I hear this all the time from Europeans who've been brainwashed by decades of stability. You're thinking that Europe isn't Argentina or Venezuela, that the euro is a major reserve currency, that the institutions are strong, that this buy property or energy or food with the same amount of euros. Look at the negative real interest rates that have been stealing from savers for over a decade. This is already happening. You're already being robbed. It's just happening slowly enough that most people don't notice until it's too late to do anything about it. The geopolitical dimension makes this worse because Europe doesn't control its own destiny in the ways that matter most. You're dependent on the United States for security, which means when American foreign policy creates chaos in the Middle East or provokes China or expands NATO, Europe pays the price in refugees and energy shocks and economic disruption, but has minimal influence over those decisions. You're dependent on global supply chains that run through choke points controlled by potentially hostile powers. You're dependent on... So what does this mean for you as a European investor trying to protect your wealth? It means you need to think like someone who lives in an unstable region, because that's what Europe is becoming, even if the decline is more elegant and bureaucratic than in other parts of the world. You need to get your wealth out of the direct control of European governments and central banks who have every incentive to devalue your savings to pay for their unsustainable energy imports from countries that don't share your values and will use that dependence as leverage. You're dependent on a financial system that's denominated in dollars, and when the U.S. Federal Reserve tightens monetary policy to fight inflation, it sucks capital out of Europe, and there's nothing the ECB can do about it without crashing the euro even further. This isn't sovereignty. This is vassalage dressed up in the language of multilateral cooperation and rules-based international order. You need assets that can't be printed, that aren't someone else's liability, that will hold value regardless of what idiotic policies the European Commission or the ECB or your national government decides to implement. And you need geographical diversification because the risk of capital controls, wealth taxes, forced conversions, bail-ins, and all the other tricks governments use when they're desperate is much higher than most Europeans want to believe.
Let's talk about what this actually looks like in practice, because I'm not interested in abstract theories. I'm interested in what works. First and most important, you need to own physical gold, and you need to own it outside the European banking system, not paper gold, not gold ETFs, not allocated accounts where you're trusting some bank to actually have the gold they say they're holding for you. I mean, physical metal that you either hold yourself or that's stored in a vault in a stable jurisdiction like Switzerland or Singapore, where you have direct ownership and control. Gold is the only asset that's been recognized as money for 5,000 years that every central bank in the world holds as a reserve asset, even while they tell you it's a barbarous relic. That can't be printed or debased or inflated away by politicians who need to buy votes. When you own gold, you're not dependent on anyone's promise. You're not exposed to counterparty risk. You're holding an asset that will be valuable regardless of what happens to the euro or the EU or any particular European government. And I know all the objections because I've heard them 1,000 times. Gold doesn't pay interest. It doesn't generate cash flow. It just sits there. You're absolutely right. And that's exactly why it works as insurance against monetary and geopolitical chaos. The reason it doesn't pay interest is because it's not someone else's liability. It's not dependent on some government or corporation making good on their promises. The reason it just sits there is because it can't be destroyed by mismanagement or bad policy or conflict. During every major geopolitical crisis of the last century, during both world wars, during the collapse of Bretton Woods, during the stagflation of the 1970s, during the 2008 financial crisis, gold has preserved purchasing power while paper currencies and financial assets got destroyed. This isn't theory, this is history. And the Europeans who had gold during these crises were the ones who came out the other side with their wealth intact. But gold is just the foundation, the insurance policy, the asset you hold, because you understand that the probability of serious monetary and geopolitical disruption is much higher than the financial establishment wants you to believe. Beyond that, you need to think about productive assets that can maintain value through inflation and crisis. I'm talking about businesses with real pricing power, companies that own hard assets or control scarce resources or provide essential services that people need regardless of economic conditions. I'm talking about agricultural land in stable countries, productive farmland that will generate food and income whether the euro goes up or down. I'm talking about energy assets, companies that produce oil and gas and uranium and copper, the things that industrial civilization actually runs on and that can't be replaced by central bank press releases. I'm talking about assets denominated in currencies other than the euro, exposure to the US dollar, not because the dollar is sound money, but because it's the least unsound of the major currencies. And the entire global system runs on it. Exposure to Swiss francs, exposure to commodity producing countries like Australia and Canada. The key insight that most European investors miss completely is that diversification isn't about owning a mix of European stocks and bonds. That's not diversification, that's concentration in a single geopolitical and monetary system that's declining. Real diversification means spreading your risk across different jurisdictions, different legal systems, different currencies, different types of assets that will respond differently to different scenarios. If there's a major conflict in Eastern Europe, your European stocks and bonds are going to get crushed, while your gold and your assets outside Europe will hold value or even appreciate. If the ECB is forced to monetize Italian debt to prevent a sovereign default, your euro-denominated assets will lose purchasing power, while your hard assets and foreign currency exposure will protect you. If Europe implements capital controls or wealth taxes, you'll be grateful that you moved assets outside the reach of desperate politicians while you still could. And this brings me to the most uncomfortable truth of all, which is that European investors suffer from a dangerous combination of recency bias and normalcy bias that's going to cost them dearly. The recency bias makes them think that because Europe has been mostly peaceful and mostly prosperous for the last 70 years, that's the normal state of affairs and will continue indefinitely. But 70 years is nothing in historical terms. And for most of European history, the normal state of affairs was conflict and monetary chaos and governments confiscating wealth to pay for their wars and their promises. The normalcy bias makes them think that the current system, the EU and the euro and the welfare states and the whole construction is permanent and stable, when in fact it's a historical aberration that's already showing cracks and will eventually collapse under its own contradictions. I've been saying for years that Europe's biggest problem is that it's trying to maintain a high tax, high regulation, generous welfare state while competing in a global economy against countries that have very different systems. And the math doesn't work. You can't have open borders and a generous welfare state. You can't have demographic decline and pay-as-you-go pensions. You can't have energy-intensive industry and the highest energy costs in the world. You can't run persistent deficits and lecture everyone about fiscal responsibility. The European project was built on assumptions about perpetual peace and prosperity and cheap Russian energy and American security guarantees and globalization and demographics that are all falling apart simultaneously. And rather than adjust to reality, European policymakers are doubling down on the policies that created the problems in the first place. So what happens when this unstable system hits a real crisis? What happens when there's another sovereign debt crisis, and this time the ECB can't paper it over because inflation is already too high? What happens when there's a serious conflict and Europe has to actually defend itself without American backing? What happens when the political tensions between Northern and Southern Europe, or Eastern and Western Europe, become unmanageable? What happens when voters in creditor countries decide they're done bailing out debtor countries, or when voters in debtor countries decide they're done with austerity. I don't know exactly how it plays out, but I know the people who are prepared will be the ones who understood that the system was fragile and took steps to protect themselves. And the people who are destroyed will be the ones who trusted the experts and kept all their wealth in the system and assumed everything would work out fine. Here's what I recommend concretely for a European investor who actually wants to protect their wealth from geopolitical risk. Get at least 20 to 30% of your investable assets into physical gold stored outside the European banking system. Get another significant portion into dollar-denominated assets, U.S. Treasury bonds, if you want safety, productive U.S. businesses, if you can handle volatility. But something that gives you exposure outside the euro. Get exposure to commodity producers and energy companies, because these are the assets that will hold value when paper wealth evaporates. Consider property in stable jurisdictions outside Europe, whether that's the US or Switzerland, or even certain emerging markets that have better fundamentals than people realize. Keep some cash in multiple currencies so you're not dependent on any single monetary system. And most importantly, develop skills and relationships and options that don't depend on the European system continuing to function as it has, because the probability that it won't is much higher than most people want to believe. The financial establishment will tell you this is paranoid, that you're chasing ghosts, that Europe is stable and the risks are overblown. These are the same people who said Greek bonds were safe, who said negative interest rates were temporary, who said inflation was transitory, who said Russian energy dependence wasn't a problem. They've been wrong about everything important for the last 15 years, and they're going to be wrong about this too, because their incentives are to keep you invested in the system they profit from, not to help you preserve your wealth through the crisis that's coming. The reality is that geopolitical risk isn't some abstract future possibility for European investors. It's the defining feature of your investment environment right now, and the longer you pretend otherwise, the more wealth you're going to lose. This isn't complicated. This is arithmetic and history. Currencies that are printed to solve political problems lose value. Governments that make promises they can't keep eventually default either explicitly or through inflation. Regions that are geopolitically vulnerable and dependent on others pay a price for that vulnerability. You can't change these realities, but you can position yourself to survive them. And the time to do that is before the crisis becomes obvious to everyone else, because by then it'll be too late.